Hi everyone, welcome back to my channel. Today I want to discuss a very impressive day trading strategy FATTYTRADES backtested for us recently using the new DEX tool using options. I've done 2 videos on market DEX so far, but wanted to discuss this particular strategy, how and why it works so well, as well as some ways we can actually improve upon it. Before we get started, I'll leave several referral codes for trading services I use in the description, including TradingView, Elite Trader Funding, and TradingView that will give us both discounts. Lastly, if you enjoyed this content, don't forget to like and subscribe to help me grow this channel. With all that being said, let's get right into it. So, I don't know, probably not everyone has seen this tweet that TradingView shared. It definitely was very popular and it definitely caught my attention. Now, in previous videos, we did indeed discuss some of the market DEX back testing from the DEX tool. Now, this back testing, I believe, only includes if you were shorting and buying shares, and it was absolutely stunning. We saw some cases where it would get as high as 400% returns. Now, the back testing here was actually done with options, and that's why, because we have more leverage with options, he was actually able to surpass I believe it was 700% cumulative gains, which is just incredible. And the amazing part about this is that he was opening a position at the start of the day and then closing it at the end of the day based on what delta exposure was from the day prior, market delta exposure. Now, if you're not familiar with this, it's on the same page as market net flow on the market dashboard under market options dashboard. If we scroll right on that, we can see market DEX, and this is a fabulous tool. It is now my second favorite tool right under market net flow. And now he was basically doing it easy mode, and there's ways that we can improve it. So let's take a look at some of these positions and let's talk about what I really like about this. So basically he would look at the DEX sentiment from the day prior. So we could see that it had bullish sentiment, so that means at the start of the following day, he was opening a call contract. And notice how this was on April 27th, 2021, and the expiration of his contract was June 18th, 2021. So he gave himself plenty of time, and there's a solid reason for that. When you do this strategy, when you're swinging options by buying options, it's very important to account for theta. The less theta that you have in your contract means that price fluctuations might trigger your stop loss too fast. Now, in this case, I forget the exact stop loss he said he was using. I believe it was 10%. So you can actually bump that up even further and increase these gains even more. We talked about it on the side and went through some other back testing data, and essentially if you bump that up to 20 to 30%, and I'll talk about what the optimal amount was, you can get even higher gains, which is crazy. But that really what really impacts that is ensuring that you buy enough time, because if you only buy weekly expirations, even though we're closing them out same day, if you get a big fluctuation in price because he wasn't really looking at where it opened and trying to find an entry level, which we'll also get into, he was literally just opening the contract and then closing it at the end of the day. So it really is just sort of easy mode trading, which makes this strategy even more appealing, because if you're someone that works a full-time job and you don't have time, you don't work from home, maybe you're working in the field somewhere, you can just go in, pop in the position at the beginning of the day based on what DEX was showing prior. So as we can see here, if we were to start doing this tomorrow will be August 30th. Today was a red delta exposure day. And another key factor that I would add to this is make sure that market net flow is in line with what delta exposure is showing us. And the reason why I would feel good about opening a put position, and I would recommend, again, doing anywhere from 30 to 90 days worth of time on that contract, even though we're closing it later that day, because that will ensure our stop loss. It's harder to trigger our stop loss, meaning if it starts going against us at first, we're not going to hit that 25% stop, which I'd recommend doing without it moving pretty significantly. Because what we don't want to happen is open up weeklies and then it moves a couple points and we get stopped out, and then all of a sudden it goes our way, and then maybe even if we choose to hold on to it, it ends up gapping down. So let's just say, and I'm going to talk about some other rules that we should add to this strategy to improve the win rate even further, but I'm just starting with the basics right now, covering what he was doing essentially. So it's August 29th, and then if we add in market net flow, we can see we did have a pretty bullish day. I mean, honestly, it was very choppy. We had a lot of back and forth. We didn't really make a big move. We closed pretty much right where we opened, right? So this was a very flat day. And if we look at SPY on the daily chart, we can see this candle here. I mean, we went up and then we rejected. And I'll talk about this level in here because I do want to point out, as one of my improvements, we can actually set better entry triggers, which will give us even better success. Now, so going into today, it did actually meet the criteria because we can see so August 26th, so this was last Friday, we had a very, very red day, and both DEX and market net flow were red. However, going into today, it was pretty flat. Now, if we bought enough time, theta wouldn't have really hurt us. We essentially closed where we opened. We actually, we would have taken a very small loss closing that out, but nothing major. And it is important to note with this strategy, you will take losses. It was a 53% win rate, but the thing is, when the market starts trending in a particular direction, the wins really start racking up. And that's the power in this strategy, is that yes, you take losses. Yes, your win rate is a little bit better than 50%, but the P&Ls, your risk to reward, is extremely significant. So no strategy is ever going to be 100%, especially a swing strategy, but this is certainly one of the better results I've ever seen. So back to today, this would meet our criteria for opening puts tomorrow. So on August 30th, beginning of the day, we could open puts because at the end of the day, market net flow went very bearish. And then also, if we just take a look at the chart, we can see that we had a big sell-off end of day. So that's a good sign. Now, by waiting till the next day, we can ensure that if we do have some sort of gap up into the next day, that doesn't go against our position. But at the same time, it also means that if we have a gap down, maybe we don't get to take advantage of it. But there is another rule that I would add into this. So besides these two rules, just looking at market DEX and market net flow, I would also make sure I go over to Market Watch and I look at the calendar, and I would make sure that events like CPI data, PCE data, FOMC, especially Jackson Hole like we had last Friday, I would make sure that there's no major events that could really throw everything off. Because let's say we're going into the day and we're going to open calls, but we have FOMC at 2 p.m. We're just going to basically chop around until that meeting, and then we don't know what kind of move we're going to get based on what Jerome Powell says. So it could just cause a loss despite what DEX and market net flow told us because of these macroeconomic events. So I would add another rule in there. I would say if you go in the calendar and you see any big events happening, now it's up to you to decide what those are. For instance, jobless claims, I don't really pay a huge amount of attention to. FOMC, I do give a lot of weight to. I also give it a lot of weight to CPI, I mean, and things like that. Now, the thing about Jackson Hole is that when we went into the day, and this is why I want to point out how it could have spared you a loss. So the day prior to Jackson Hole was August 25th, and this indicated it was going to be a bullish day, and market net flow was also bullish that day. However, we could see what happened the next day. I mean, we just completely dumped, and that was because of a macroeconomic event. We had Jackson Hole, we had Jerome Powell speaking, he was very hawkish, and it caused the market to crash. So let's take a look at that. So if we would have opened a position at the beginning of the day, just completely ignoring this macroeconomic event, and then the day opens and we get this initial chop and things are looking like they might be okay, and then we just completely dump, our stop loss, whether it be 10%, 20%, 30%, would have been hit in no time. It was just such a dramatic of a fall. All that pain could have been spared by simply just staying out, especially if you want to trade very passively. Now, if you want to, if you can still look at the chart and you still want to have a position to hold the entire day, then obviously when you see this happening because of the macroeconomic event, then sure, absolutely go ahead and open up puts. And then I also want to, so not only should we pay attention to upcoming macroeconomic events when we're opening these positions to make sure that the win rate is even higher than that 53%, so we don't get caught off guard by something, some sort of data point or something that someone from the Fed ended up saying. But we can also leverage entry triggers. Now, what I mean by that is if we go over to the tickers dashboard and we actually choose stocks on this one. So we have our options dashboard and then we have our stocks dashboard. TradingView has this awesome chart where we have all kinds of levels that we can put into play here. And I just want to talk about how we could have used this today, just looking back historically. So just to review, on August 26th, so which was the Friday before today, we had a big red delta exposure bar, and then market net flow was incredibly bearish that day. It showed bullish for a time, but that was because of a bug. It was because SPX and VIX data got added in, which threw everything off. But once that was corrected, it was very bearish, which we would expect because price was just dropping so rapidly. So let's say we wanted to open a position up on the beginning of the day, but we wanted to be a little smarter about it. We could go in and here we could look at things like dark pool levels. We could look at not projections. Here, let me clear this out. So we could look at dark pool levels. You can do daily, weekly. We can look at gamma levels, delta adjusted gamma levels, Vanna levels, which I've talked about in other videos, or we can just look at good old standard support resistance levels. We can draw these on our charts, and then we can make sort of a more well-educated guess on where a good entry trigger would be. So let's just take this dark pool level, for instance. If we just draw it from the day, we can see this dark pool level is at 405.30. And if we go to our TradingView chart, so let's say the day's opening and we know about that dark pool level, and so we tell ourselves, okay, I'm going to open puts because DEX was bearish and market net flow was also bearish, but I'm not going to do it until we come up to that dark pool level because I'm expecting a rejection there. So if we pop in 405.30, we can see what happened. Now, this will cause you to miss some trades, and if you do this and you want to keep it passive, then I highly recommend going in and adding an alert, so that way you get notified when it's about to hit your levels. Pretty much every trading platform allows for that. So you can see this might even look like it was going to run away from us, but in this case, it did end up getting up to our level. Now this is late in the day. I mean, this is around 1:45 in the afternoon. I mean, we actually did touch it here at around 12:50, so you could have even opened your trade up here. And then let's say you entered your puts. We actually never break past this level. So, and dark pool levels are always very strong levels. So are big gamma levels, which those are actually going to get improved even further from conversations we had with some experts in the industry recently, which I'm very excited about. And once those are out, I'll certainly make a video about it. But let's say we did open up this put, even though we'd be closing it at the end of the day. So let's say we decide to close it. Most brokers allow you to trade SPY options up until 4:15 nowadays, but let's say we were just going to close it at 4. You still would have actually been profitable here. Whereas if you just opened it up blindly at the beginning of the day, even though it looked like you were going to miss the trade, if we use this dark pool level or we used a gamma level, we can see that it did indeed actually hold, and this would have actually become a profitable trade instead of a loss on the day. Now, if it was a loss on the day, again, it wouldn't have been very big, because as long as you bought enough time, your options contract would not have been impacted all that much. You'd close out your position, you take your loss, and then basically, based on what we're seeing now, we'd be going into tomorrow looking for the same sort of thing. And once again, depending on where we open, which I don't have that data right now, but depending on where we open, we could do the same exact thing. We could go in and we could find the level closest to where we're opening in the pre-market. And since we know we're going to be taking puts and we're going to be buying 30 to 90 days worth of time on those, we could mark those levels and take our trade off of those when the time comes. And for those that don't know, you can actually copy these levels to TradingView now, which is a really nice feature. So if you do use TradingView, you can pop them in pretty easily. Now, the other thing is deciding if we want to leave the position open. And this is going to have to basically be a judgment call, right? So I would personally choose to leave the position open oftentimes, especially because there's so often where when DEX is really red, and I would have to look at it like, so when we get these big red bars, these big sell-offs, for instance, if it's a small bar like this, maybe I'd close it. We look at the end of the day and it's a small bar like this. However, when it's a big red bar like the ones we're seeing here, where it's all the way down to -1, then at that point I'd consider leaving it open. Now, as we talked about, today wouldn't have been very much, but this position would have been up so much, especially if we had opened it off the Jackson Hole rejection and then we were trying to decide if we wanted to leave that swing open. and we decided to do so because market net flow and DEX were red, we'd already be up so much that today's flatness wouldn't have bothered us because we would have enough time on the contract where it wouldn't have really gone against us all that much, and we would still be in significant profit. Now, but that's that's going to have to be a judgment call, and by closing a position at the end of every day does indeed take some risks off, because you can't control what happens in the overnight when you're trading options. And it might be also a consideration, because you could also do this with ES futures. Now, you can't do it with a prop account because they require you to be flat going into overnight, but you could do it with your own account, assuming that you meet all the margin requirements. You could just leave that position open and then have some sort of stop if it decides to start going against you to a certain degree. And really, just by adding in those basic things, entry triggers, making sure market net flow is in line with what DEX showed, making sure that we're avoiding macroeconomic events, making sure that we buy enough time on the contract, we can have a lot of success on it. Now, the one last tip I want to give is some of the drawdown issues that I saw with this. If you see here, we can see that this equity curve is really, really great. We started moving up pretty well. We went flat for a while. We move up very well. And then we see this drawdown right here where a lot of our positions were getting eaten up. Now, if you go with a 25% stop loss and we start hitting these drawdown problems where we're wrong day after day after day, so we're getting consecutive losses in a row, what you need to do is when you first take your loss, so say you hit your 25% stop, reduce that by 7%. So all of a sudden, when you open your next position for the following day, your stop loss is now at 18%. If you lose again, drop it down to 11%. And essentially obviously you can only do that to a certain point, but when you do that, you limit this drawdown. That way you're getting out quick if it continues to go the wrong way, if it continues to go against you, and this drawdown gets very limited. And then as soon as you get a win the next day, which is bound to happen, eventually you're going to get a win the next day, and it's likely going to be a significant win. Like we can see here, when it started going back in our favor on this day, it was a significant win. That's when we want to reset our stop loss back to whatever we had it at. Whether you decide to have it at 10, 20, 30, or what I'm recommending is 25, we would just set our stop loss back to 25. And then, of course, once we get a loss again, we would reduce it by 7% for the next position. And that really cuts down on this drawdown. Unfortunately, I don't have a chart to show you doing it that way. However, I can assure you the drawdown would not be this brutal. It would be a much smaller drawdown period, and then we would, once we got out of that choppiness that caused all of this, we would resume with this amazing equity curve, and we would certainly be surpassing the 800% cumulative profits shown here that were almost hit. So just a quick tip that was shared with me actually from TradingView and then TradingView, and then he learned that from a professional trader. Actually is a great tip for swinging positions. But so hopefully reviewing this helped cleared up how this was done, what they were doing, what he was doing in this. This is on the TradingView Twitter, so you can review the data for yourself and even toy with the numbers if you'd like. It was a really great back test that he put together for us, and I'm just stunned by it, and I am now implementing this myself. So I appreciate you watching. Of course, if you have any questions, definitely let me know.